What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown. Today we are talking about platforms and specifically the death blow that Schwab just dealt to the smaller online platforms like Robinhood and Stash. Schwab just recently announced that sometime in June you'll be able to start purchasing fractional shares of any stock that is a part of the S&P 500 through your account at Schwab. And while they are not the first to do this, it is yet another nail in the coffin on companies like Robinhood, Stash, and some of the others out there. This is a slightly different type of video than I normally do, but I've been getting questions recently about the platforms that I use, platforms that I prefer, so we'll be going into that in the video as well. Let's dive in. Over the past few years, we have seen a number of small online-only brokerage firms open up, and they're primarily mobile-based. They have apps, and you can't really do anything with their websites. Companies like Acorns, Robinhood, Webull, M1 Finance, these are all companies that are focused specifically on the younger generation, millennials, people who have just a small amount of money to invest. They're usually commission-free. The mobile experience is supposed to be superior. Their apps are supposed to work pretty well, and they've been disrupting the space. The next level of companies that you have is going to be companies that are usually called discount brokerage firms, and that's going to be Charles Schwab, Fidelity, E-Trade. It was Scottrade. They got acquired by TD Ameritrade, Interactive Brokers, and these are companies that disrupted the investing industry just a few decades ago. And then you have some of the older, larger legacy dinosaur firms. You've got Merrill Lynch, Edward Jones, Goldman Sachs, Morgan Stanley. Now, if I'm painting with a broad brush stroke here, the companies like Robinhood and Acorns and Webull are going to be aimed at attracting the younger generation and the people who don't have a lot of money to invest. The next level of companies like Schwab and TD Ameritrade and Fidelity are going to be aimed at the middle class, really. People who are still fee conscious and they don't want to spend a lot, but they need additional services beyond just buying a commission-free stock once in a while. And then the last group is going to typically be for your ultra high net worth clients who are looking for services that are highly tailored and individualized based on private equity and their own businesses and tax planning and things of that nature. However, over the last year, really specifically, there have been a number of moves that middle group has taken that has kind of given some competition to both the ultra high net worth individuals and the low income individuals that are coming in with just a few bucks per week or a few bucks per month to invest. The first thing that they've done is they've pretty much all gotten rid of commissions. And so that was the main advantage to investing somewhere like Robinhood, is that you didn't have to worry about paying a commission when you bought or sold a stock or an ETF. But that advantage is no longer there, because whether you invest at Interactive Brokers or TD Ameritrade or Fidelity or Schwab, you're not going to pay commissions anymore. They've all gotten rid of their commissions. The other advantage that you get by going with somebody, let's just use Robinhood as an example, the onboarding experience is very easy. It's an extremely slick app, and it's simple to use, simple to operate, and there's not a whole lot of bells and whistles that might get in the way of doing what you want to do, which is just buy or sell a stock here and there. The problem comes down to when you need something a little bit more than that. Like, for instance, if you use Robinhood, go try and call them. You can't. Try and find a phone number for them. Their customer service, along with Webull and M1 Finance and some of the others, it's some of the worst customer service of any of the companies out there. It's just pretty much non-existent. You can find hundreds, if not thousands, of examples of people complaining online about, hey, I placed an order for a stock, or I tried to place a trade and it just didn't go through, or the platform was down when I really needed to trade. This was going on when the market was collapsing back in March. And their customer service is basically non-existent. And so if you have a problem, you're stuck, you're out of luck. And so that's a huge advantage to going with a larger, more established company that has, 24/7 customer service that you can actually call someone and talk to and say, hey, solve my issue for me, deal with this issue for me. Now, another concern that you might have is, what if I need something in addition to just my standard buying and selling of a stock? What if I want to get into, doing some options trading? Or what if I need to open up an account that is different than just an individual brokerage account? What if I, have a couple kids and I have a trust and I want to place my brokerage account under the name of my trust for estate planning purposes instead of just my own individual name? What if I want to trade on my desktop and have, live streaming software with better charting capabilities? All of these things, these are services that are going to be available at no extra charge if you go somewhere like E-Trade, TD Ameritrade, Vanguard a little bit. They're pretty behind with the technology, but for the most part, these discount brokerage services are going to offer all of these things at no additional cost. And you're, again, still not paying commissions for your trading anymore. Now, where's the trade-off? If Robinhood and these other apps were not charging commissions before, how were they making money? And now that nobody else is charging commissions, how are they making money on trades now? They're getting a lot of their trading revenue from the spread between the bid and the ask. So here's an explanation of what order execution is. When you see a price that's listed for a stock, you're going to see one price, $10. But there's never actually just one price. There's always two prices. There's a price at which the lowest seller is willing to sell, and there's a price at which the highest buyer is willing to buy. And there's always going to be a small difference between the two. If you're looking at a foreign stock or a penny stock or a stock that's very thinly traded, there'll be a wide gap between them. You know, like the buyer who's willing to pay the most for that stock is going to spend $10 on it, whereas the seller who's willing to sell it for the lowest amount possible is going to be trying to sell it for $11. So you're going to have a 10% spread there, a $1 spread on a $10 stock between what you could buy it and sell it for. Now, who's getting that spread initially? That's going to be market makers. And market makers are separate companies that their only job is to make a market in a security, make a market in a stock. They're there to provide liquidity. They're there to make sure that at some price, there's always going to be somebody to buy or sell from anybody else who wants it. And because they're the ones providing that buying and selling, that liquidity, the way they make money and compensate themselves for the risk of providing that service is by charging a spread. Now, in order for market makers to get business, they're going to go to places like Robinhood and M1 Finance and Charles Schwab and TD Ameritrade, and they're going to say, send us a lot of your business and we'll kick back some of our spread to you. And so with no commissions in place for companies to get revenue from commissions on trading, they have to rely on that a lot more to make their money from trades. And so they'll route their orders to market makers that give them good execution, whether it's speedy execution or whether it's a good price on execution. They're going to route their orders to the market makers that are giving them the best deal. And then it's up to the company, Schwab or Fidelity or TD Ameritrade or Robinhood, to pass that on to you or to keep that themselves. In practice, let's say I want to buy a share of Tesla. Now, the market maker is going to have the two prices, one for buyers and one for sellers. Let's just say, for example purposes, they're trying to sell Tesla at $7.81, but they'll buy it from anybody at $7.79. So let's say there's a $2 spread there. That's a very large spread in practice, but just for the example. So they're saying we'll buy it from anybody at this price, we'll sell it to anybody at this price. And so they've got a $2 spread between the two. Now, TD Ameritrade comes into the mix and TD Ameritrade says, hey, look, that's a big spread. And so we'll send you 10 million trades per day, but you have to give us better pricing than that. You have to give us, pricing that's twice as good as that. You've got to meet us in the middle halfway. And so the market maker says, well, that's a lot more business than I'm getting right now. And so, yeah, it'll be worth it for me to give you a big discount, basically, a better fill on both the buys and the sells, because you're giving me a lot more trading volume. And so I'll make up in volume what I'm missing in revenue per trade. So then TD Ameritrade says, great, that's fantastic. So now the client, when you place a trade with TD Ameritrade, instead of you getting filled at the bid or the ask, TD Ameritrade is going to be able to get a better fill than that for you. So instead of you getting filled at $7.81 if you're trying to buy and you have to buy that higher price, or getting filled at $7.79 if you're trying to sell, you have to sell it at that lower price. They're going to come in the middle, and maybe you get a 50-cent better price on the buy or the sell. Now, it's up to TD Ameritrade. Are they going to pocket that 50 cents themselves, or are they going to pass that through to you? Well, I'll give you a hint. None of the online apps like Robinhood or Webull, none of them are passing that on to you. When you place a trade with them, they're going to get the best price possible for themselves, and they're going to pocket the difference and give you the minimum legal necessary, which is going to be the stated bid or ask that's on the market at that time. Yes, they're getting a better price, and they're not passing that discount or those savings on to you. However, if you do your trading somewhere like TD Ameritrade or E-Trade or Fidelity or Schwab, Schwab, you're going to get at least a little of that kicked back to you. Now, the final advantage that has been cropping up is going to be taking advantage of fractional shares. And admittedly, this is going to apply to people who have lower incomes or lower savings, lower amounts of money that they can dedicate to investing at this time. And as your wealth grows, as your income grows, and as you build up your portfolio, it's not going to matter as much to you. But if you're just starting out, it makes even less sense now. Pretty much there's no reason to go with somebody like, go with Stash or Robinhood or anybody like that, because now even some of these basic services like fractional investing in shares, you can do that at Interactive Brokers. You can do that at Fidelity. You can now do that at Schwab as of later next month. And still, you pay no commissions. So if you want the most control over your investing, you want the most services available to you, you want the best technology across all the platforms, and you want good pricing, there's really no reason to go with anybody but the main 4 discount brokers out there: TD Ameritrade, E-Trade, Schwab, and Fidelity. Vanguard, maybe, but again, they're lacking in the technology department. Okay, so who are my favorite? It depends on the platform and what you're doing, what kind of trading you're doing. Let's say you're on a Mac and you're going to be trading heavily, doing day trading and options. I like TD Ameritrade's thinkorswim. It's the most robust platform with all the features, most capable, has the most customization, and it runs really well on Mac. If you use a PC, however, a Windows computer, and you are doing the same type of trading, a lot of heavy trading with options and day trading, I actually like Schwab's platform, Street Smart Edge. The user interface is just a little bit easier to get used to, especially if you're introducing yourself to a new platform, and it's just a little bit smoother with the way that the layouts and words and colors and numbers are all able to be customized. The only problem with Schwab Street Smart Edge, it will run on Mac OS. It's just a little bit more glitchy. It uses, it's a Windows-based program, and so you have to install a Citrix receiver and run it through the Citrix receiver on your Mac instead of having it be, a native program that runs on the Mac OS. And so it's just a little bit more complicated if you use a Mac instead of a PC. Okay, so what about mobile? For mobile trading, my absolute favorite app is thinkorswim by TD Ameritrade. It's just streamlined, it's what you need, it's very quick and very simple to use. That being said, if I'm just looking for quotes and looking at charts on my phone, I really like the investing.com app. And for quotes and charts, it's very quick. It has access to all the futures, commodities, currencies, cryptocurrencies, bonds, and precious metals. So that is my take on platforms. It varies between the device that you're using, whether it's a desktop or mobile. And once you remove the factors like the customer service and the pricing and boil it down to a couple choices for yourself, really the main thing that's going to come into play here is honestly personal preference. You're going to get used to something, and that's fine. Just use it. Let me know what your favorite is, and if I missed any big ones that you think deserve a spot on this list in the comments section below. And thank you for watching. If you did enjoy the video, please hit that like button to help out with the YouTube algorithms. You guys are the best. Have a great day.